Hello and welcome back to the Abundance Mindset Podcast, where we break down complex ideas into practical tidbits that you can actually use.
Today, we're talking about the wonderful world of incentive stock options for the people who are fortunate to have them through their employer.
So, for anybody who's listened before, it's obvious that Allison's not with me. We actually have our. I don't want to call you like the secret member of our team, but you kind of are the hidden member of our team. So this is Andrew
I am there.
Knudsen.
Yep.
So yeah, Andrew actually has been working with Allison way longer than I have. Was it 2018?
Yeah, 18 or 19 for you Northwestern Mutual folks that remember us being there. So it's been, what is that, 6, 7, 8 years almost.
Yeah. And
So-
2022 was the year that you guys both jumped independent. And
Yeah.
it's actually funny. I remember talking to you before Allison decided to go independent the way that we are structured currently. She was exploring a lot of different options. I remember she pulled you onto a couple different phone calls with different firms, different platforms, and tried to figure out, okay, how, because always in Allison's mind, I was like, how can I work with Andrew?
Yeah, that's what we were trying to figure out to solve for.
Yeah, which I mean, I just like speaks to you because you are like truly the glue that holds everything together behind the scenes. So
we're a good mix, especially now with you two here. So
yeah. No, I like to think we're a good team together. But yeah, we don't make you come and speak in front of people a lot. But Allison saw this topic coming. She's like, I don't want to touch incentive stock options.
More for the nerdy brains type of people like me.
Yeah, I mean, look, she gets into the spreadsheets for sure, but she's like, oh, this, if you're going to talk about alternative minimum tax, I want no part of this. So Andrew graciously stepped in, and you are, we're like, we got to get Andrew on before you become a father, which is happening later this year too.
Yep. Following up with declines with our own baby girl that's due in August. So taking that next step in life here.
Yeah. So that makes the 25-minute drive to our house a little bit harder once you got a little one running around. So
yeah. Well, we'll figure that out when the time comes. But
well, thanks for being here. Okay, talking about incentive stock options today. Like you mentioned, this is one of the most or more complicated forms of equity comp. So, there's always a disclaimer over our episodes, but just like note, this is educational, not advice. Like if you've got this type of equity compensation, don't go running around doing things just because you watched this. Talk to somebody about your personal situation. So real decisions require some real personalized advice. But incentive stock options. So we talked about non-qualified stock options on a previous episode. So if you have those through your employer, you can listen to that. But incentive stock options, often called ISOs, they're usually showing up at smaller companies, tech companies, startups, fast-growing firms. On the surface, they sound really nice. They've got some preferential tax treatment, which we'll talk about, but there's a lot of planning under the hood that we need to look at.
Yeah, and by no means does every single person run across this topic through their employer. It is pretty limited to who gets access to them. Typically, more of those higher-level, highly compensated people. I like to see it as like what's called the golden handcuffs. Where it's a way for employers to essentially incentivize you in multiple ways, both for you to stay at the company, to raise their stock price, and then also for you not to leave as well. So there's all sorts of rules around keeping incentive stock options if you were to leave or whatever it is. So employers use that as a way to retain employees for sure.
Yeah, this is anecdotal data or anecdata, but I have seen it several times with acquisitions, right? Where it's, I think, particularly that's a moment in time where a startup gets acquired and some of the key employees, they really want to keep them because it's actually a big part about making the acquisition work, right? So that's a lot of times where ISOs for the company that you're being merged into start a lot of times get granted.
Right.
Yeah. So today we'll talk about how they work, how they're taxed, what makes them different from non-qualified stock options, and then really get into just some of the key strategic variables that you want to look out for. But before we get into any of that, let's just cover some of the terminology that we're going to use in this episode.
So to start talking about ISOs, what we want to cover first is the common terminology of the language that the employer will use when giving you these incentive stock options. So the first term, the most common one, is stock options. So what they're doing there is they're giving you the right to purchase your employer's stock at a certain point or a certain price. So typically it's at the market value at the time that they give you the grant. And then it's kind of your incentive to kind of raise that price in the future. And it's your decision whether you want to exercise that or not.
Yep. Yep. And the specific term for that set price is often called the strike price or the exercise price. So this is the price your employer sets at which you are allowed to buy the stock for in the future.
Yep. And then there's the vest date. So you're not necessarily going to get the right or the access to exercise that stock option right when the employer gives it to you. So vesting date, typically they're putting a vesting schedule on of anywhere between 0 and 4 years based on their discretion. So there is a point in time that you have to wait until you get that ability to what we call exercise that stock option and make that purchase of your employer's stock on that vest date.
Right. Yep. And then after the vest date, there is specific to options what's called the expiration date. So that is the deadline to exercise the option. Most ISOs are expiring 10 years from grant or much sooner if you leave the company.
Yep. And then when we start talking about the different prices, there's this term called the spread. So there's going to be the price that the employer grants you the stock option at. So that's the strike price. And then there's the price eventually when you decide to exercise that option. So let's say they let you buy it at $5. It grows to $10. That $5 difference is what we call the spread in between the grant price and then the exercise price.
Yeah. We'll talk about tax a bit in this episode. A key tax phrase or tax term to know is long-term capital gains rate. So this is a different tax bracket separate from your ordinary income tax, and it's applied specifically to gains on assets like a stock or an ETF in the tax year when the asset is sold. For many people, their long-term capital gains rate is lower than the ordinary income tax rate, which can make it advantageous.
Yep. That's the big difference between incentive stock options and non-qualified stock options is there's this kind of underlying layer of the difference with tax treatment where they've got an opportunity, if held for certain periods, you can lock in that long-term capital gains rate versus ordinary income rates, which are typically a little bit higher than what those long-term rates are.
Yeah.
But something to watch out for, something to plan for, as there are different tax consequences based on holding periods.
Yeah. Okay, so let's get into how ISOs actually work. Yeah, thinking about people listening who might have an ISO grant. So on the surface, they're going to look and feel kind of like any other option. You might not even know whether you have an ISO or an NSO. It will always say on your option grant, incentive stock option or non-qualified stock option. So that would be the first thing to look for. But both are going to have the strike price, right? They're both going to have a vesting schedule and an expiration date. Once you have your options vest, with any type of stock option, you then have the choice of when to exercise. But here's where ISOs change. So when you exercise an ISO, there's typically no ordinary income tax due at exercise.
So unlike with non-qualified stock options where you're getting hit with that ordinary income tax, essentially when you exercise and purchase that stock option based on the prices, with a incentive stock option, there's no immediate tax event. There are a few different planning considerations to consider down the road based on the time when we exercise that and then how long we hold it. We'll get into those later. AMT is a term we'll use, but just something to think about as far as the tax difference and what a non-qualified stock option looks like and then an incentive stock option.
Yeah, so like you're saying, Andrew, we're not being taxed immediately on ISOs. Like that's the headline positive feature if you have one. But the thing that a lot of people miss, and if you've looked into ISOs, some and you have them, you might have heard a little bit about alternative minimum tax or AMT. So that is, we won't like do a full AMT breakdown in this episode because that's kind of a separate topic. But AMT effectively for every tax return that's filed runs on the side. It's an alternate calculation, and incentive stock options don't qualify as income, but they do show up on the AMT calculation. So if you depending
Mm-hmm.
on your specific circumstances and income and all sorts of other things going on in your life, you could end up having the AMT calculation used for your tax return if you aren't, and push you into higher tax rates if you aren't careful with your exercise strategy for your ISOs. So
Right.
that's the first big watch out. The second big watch out is you aren't going to automatically qualify for this positive tax treatment unless you meet the holding period requirements for ISOs. So
Right.
after you exercise, you need to hold the stock for at least 1 year after exercise
Yeah.
and at least 2 years after the grant date. So
Yeah.
make sure you pay attention to both of those, right? Because if you
Yep.
get one but miss the other, you still get what's called a disqualifying disposition.
Yep. And I'll mention too, one other planning concept that we want to be aware of is relating to this AMT taxes. There's kind of a balance that we need to watch for. Hey, do I exercise this incentive stock option right away, or do I maybe hold on to it and exercise it later? Because typically what happens later, assuming there's good company performance, is now there's a even larger gap in between what we call that spread.
Mm-hmm.
So the spread, the bigger the spread, the bigger the AMT potential liability can be. So we want to make sure we're setting up a game plan for, hey, do we exercise this right away? Then there's typically no AMT impact because there's a very minimal spread. Or if we hold on to it longer, maybe now there's a risk for an even bigger gap there that we need to report for tax purposes. But yeah, disqualifying dispositions, that's where we're talking about not meeting that 2 year from grant date, 1 year from vest date rule. Essentially, if we don't meet those definitions, it kind of just turns right back into a non-qualified stock option in the sense that it gets treated for taxes.
Yeah, basically there's no way around the qualifying disposition
Yeah.
rules. So, if you have a trust or you want to be charitable with your ISOs, many times you can kind of get more favorable tax treatment by using charitable or trust levers.
Mm-hmm.
Doesn't apply on ISOs. You still need to satisfy both those holding periods. So
Right.
yeah, gifting doesn't get you around holding periods is kind of the
Right.
bottom line there.
Yep.
But yeah, so Andrew, you're mentioning a little bit like one of the like kind of the planning trade-offs, right? Of like, do I exercise right away and have a minimal AMT impact, or do I kind of,
Mm-hmm.
bet on my company for 1, 2, 5+ years, right? And see
Yep.
if that spread increases. So just to like say it plainly, like there's really 3 strategies that you might employ with ISOs. So
Yep.
exercise and hold, that was the first one you're talking about. So like
Mm-hmm.
minimizing AMT exposure, you exercise the options, hold them, and then any growth is treated as long-term capital gains above the strike price. So
Mm-hmm.
this can be really advantageous if the stock grows, of course, and
Mm-hmm.
does typically limit AMT exposure if you're exercising earlier or closer to that strike price.
Right. There's also the option of exercising and sell immediately. So that goes back to our conversation around if we want to minimize maybe that AMT liability. So as soon as that incentive stock option vests, it becomes available to us. We now have the right to purchase that. We're essentially just exercising that right away, selling it right away, and we're getting that profit of what the spread is based on the difference of what our employer let us buy it for versus what we're actually buying it for at that time.
Right. Yeah, and this one, it's not very sexy because you avoid all or you don't
Mm-hmm.
get access to all the advantages of ISOs, but sometimes these
Mm-hmm.
can be a really big chunk of somebody's income, or there could be kind of a liquidity risk where they don't have a
Right.
lot of cash on hand to just hang on to a bunch of really risky stocks. So
Mm-hmm.
it is always an option just to take your option and say, I'm going to just cash out this difference and take
Yeah.
the tax hit. It's not
Yeah.
always good to
Yeah.
roll the dice on your
Yeah.
stock.
Especially if you're kind of down or not too optimistic on the future of your company. That's kind of the way we'd go in that route. But
Yep. Yep. And then the last option, and this is the one where that second option is probably the least risky. This is,
mm-hmm.
This one has the most upside, but also, can, expose you to more AMT risk. But if you wait to exercise, right? So most ISOs are going to give you 10 years before you are required to exercise.
Yeah.
Say your company grows a lot during that time, you can get that advantageous tax treatment on, the entire spread. It's just you want to be really mindful of how you're going to exercise, maybe run some tax projections ahead of time, because you could end up with some tax surprises if all your dreams come true, your company does awesome, you exercise a ton, and then your tax bill comes in April and it's way more than you expected. So that's the risk on waiting to exercise. And then, of course, your company could also just do poorly too, which is also a risk.
Yeah. And then what we don't want to have happen is people just never do anything, right? Because some people just never do anything. Options will expire after that 10-year time period. So just a very good planning opportunity we see with ISOs to take advantage of one way or another.
Yeah, absolutely. So if your head's already spinning with this, you're not alone. And that's why at Abundance, we created a free equity compensation guide that goes over not just ISOs, but 11 other types of equity incomes. Just kind of gives you the basic rundown of how they work, the different tax levers involved, and some of the key strategies that are associated with them. So you can get this by signing up for our newsletter, which we'll link in the show notes. But this is a really helpful first step if you have an equity comp and you're looking to try to understand it better.
All right, so next with ISOs, we want to get more into kind of the risks we see as planners of the what ifs with incentive stock options, right? So we have concentration risk. So what a lot of people kind of forget about when they're looking at their balance sheet is their allocation that they have to their company stock now through these incentive stock options. Whether they're vested or not, we kind of treat that as, hey, this is part of your allocation that you have towards your employer stock. We're typically trying to limit that to maybe 5-10% of an overall portfolio, to not kind of go all in and have our whole career and future dependent on on the outcome of the company that we're at.
Yeah, we see. I mean, again, a lot of times this is showing up in smaller companies, high growth companies. So there's already, more risk, I think, than people are often perceiving that's on the table, right? So when and then moreover, because these companies are high growth, a lot of times they don't have as much cash to throw at you, right? So they throw more equity at you, and you can just very quickly get flush with equity. Can have a lot of upside, but it can also really hobble your plan if things don't go to plan with your company.
Right. Liquidity needs, that's another one we want to hit on, because unlike what are called restricted stock units, where your employer is granting you those shares, you don't have to pay anything for those. They're essentially kind of giving you it as a bonus. With incentive stock options, there is a price that we have to pay in order to acquire those stock shares. So based on the vesting price or the exercise price, we're going to have to front the bill in order to buy those shares. Now, you do have the opportunity, if you want to sell them right away, you can profit off of that, but that's at that less preferential tax treatment. So it is a consideration to be able to plan for, to make sure we have that liquidity at the time of exercise.
Right. Yeah. And I mean, of course, it totally depends on your grant and the situation and the price of the stock. I mean, sometimes these are grants of pennies, but pennies at thousands of shares can be thousands of dollars or tens of thousands of dollars, right? So, yeah, it's really personal to your financial plan in terms of like where you're at, what your cash position is at, and your ability to sustain, basically a cash hit to buy incentive stock options, not sell them right away if it's your plan, right? And then hang on to them, right? There's cash outflow required, which a lot of times, we're used to equity compensation or just compensation in general coming to us, right? But in this one, we have to pay in. So yeah, that's definitely a planning consideration when you're looking at exercising your grant.
Right. And there's also other options too out there. It's not a decision we have to make where we're saying you're going all in, you got to buy everything, you got to exercise everything. There's also options where you can do partial exercises. You can spread it out over multiple years. That's kind of where helping with planners obviously helps with looking at more at that long-term time horizon, the impact over time, to be able to take that into account.
Right. And I think that's actually maybe even like the key concept to sort of land the plane on with ISOs, which is options give you a lot of flexibility in income planning. Like they're a big lever, they're a big potential risk, right? But they can also be really powerful. And general advice, not specific advice, but oftentimes like good ISO strategies are forming a plan and using equity comp as a lever to modulate income over time and soak up the most advantageous tax brackets along the way. What you don't want to do is exercise on a whim or as a reaction to a big move that your company makes either up or down.
Right.
Because if you're doing it quickly without a plan, without a multi-year strategy, that's where people end up with the tax consequences that they're not happy about.
Right. All right. So another planning consideration to take into account is what happens if I'm planning to leave my employer, or I've left my employer and I'm sitting on some of these incentive stock options. So a few different things. So anything that's unvested, that's going to be forfeited by you leaving the company. So you're not going to have access to any of those. Anything that has vested, you do have the option within 90 days of leaving your employer to exercise those shares. As long as you left on good terms, you still have that right. If there's bad terms and you leave, employers do have discretion to take that away from you. But it is important to remember that 90-day rule. In the event you kind of voluntarily leave the company, it is something that you can still keep and exercise in that time frame.
Right. Yeah. And I think that's where that's maybe a good note of being very astute on your specific plan document to see if there are clawback provisions or ways that your employer can, because like 90-day rule would be like the standard treatment, right? But there are ways that it could be subverted, right? So if you're planning to leave, plan your ISOs before you leave would be probably the best rule of thumb.
Yes, because in the end, employers always have the rights based on how their plan document is written. Like Ben mentioned, the clawback provisions, technically they can have writing in language where they can take those back from you after you have left the company.
So bottom line on incentive stock options, they offer some of the best tax benefits in equity compensation, but only for those who understand the rules and the plan's benefits. They generally are rewarding long-term thinking, disciplined timing, honest assessment of risk. When they're mishandled, they can create surprise tax bills, concentration risk, liquidity stress. So ISOs aren't inherently good or bad. We have to think about them as a tool and a lever within your plan. And like any powerful tool, they need you to have a steady hand and a good plan in place.
Yep, for sure. But we don't see them very common kind of across the market as a whole. The employers that do offer them, they're super leveraged tools that we can see with planning clients to take advantage, especially if you're optimistic about your company going forward on really taking advantage of buying in at that lower price the employer's offering you, and then even getting that preferential tax treatment that comes with ISO, assuming we've kind of got that long-term holding period met.
Yeah. Yep. All right. Well, if you've made it with us this far, I'm guessing you either have ISOs or maybe are hoping or expecting some in a future transition that you're making. So just a reminder, you can get a guide to ISOs as well as other equity comp by signing up for our newsletter in the show notes. Also, if you want to just make it more personal and figure out what to do in your personal situation, we do offer complimentary strategy assessments, which you can find on our website, which we'll also link and request via the website. So thanks for sticking with us. Hope you found this valuable, and best of luck with your equity comp.
Happy to be here. I'll be back soon.
Yeah, right.